Hey guys, welcome back. Patrick here. In today's video, we are going to talk about the best stock of 2022, which is by far, in my opinion, Enphase, ticker symbol ENPH. Enphase is the total package. They have growth and they have very strong profits, and you don't find that very often in the market. So currently, even though, the stock market's not in a great place, well, these are the type of premium companies that you need to focus on and really pay attention to. In this case, just to let you know, even people that are bearish on Enphase are like, okay, the price is starting to be really attractive now. So let's get started. You guys can do your own research, of course, and let me know what you think, but I think you're going to really want to pay attention to this one. Alright guys, welcome back. One of the questions you ask me most often is, Patrick, how do you actually find companies that are great to invest in long term versus the ones that are going to be flat or even decline? So what I like to do is go top down, meaning I start by focusing on the industry itself versus just the company, right? There's this expression that rising tides raise all ships. It's not necessarily true with the stock market, but definitely it's a great thing to have wind at your sails, to have those tailwinds that are going to help your company grow in the future. In this case, Enphase is in the solar industry, but more broadly in the energy management systems industry. And do we think it's actually going to grow in the future, or is it going to be flat? So as we go into more the age of green energy, we can assume that this is actually going to be growing in the future, right? If we look at some of the reports, for example, this one, Global Microinverter Market Report for 2020 to 2025. So microinverters are the hardware and kind of the software backing it that converts the energy from your solar panels into energy that you can use with your appliances and, stuff in your house. So according to this report, the market was valued at 2.5 billion in 2020, and this is going to jump to 6.5 billion by 2025. All right, so that is a compound annual growth rate of 20.8% between 2020 and 2025, which means that Enphase, being in that industry, and microinverters are their core competency, right? Their core business. That means that if they just follow the market, don't really gain more market share than they already have, they would pretty much double between now and 2025. So that's a pretty good start, right? We know that the industry is favorable for our investing, right? The industry is going to grow, so that's going to help our company. Now, the second thing I like to look at is, well, the company itself, like, where do they go from here? What is their business model? And can they actually expand later on laterally or vertically? Meaning, can they add more products, or can they actually buy some of their suppliers and things like those? Can they start to supply other companies and so on? So Enphase started with the microinverters, as we talked about, right? They don't make the solar panels themselves. They kind of make like what controls the solar panels. They recently expanded to battery packs, right? So that is expanding laterally, and that is going to add a lot of revenues and a lot of profits in the future as more and more people want to add like battery solutions to their house, eventually to the businesses, and so on. So that is one of the great things I like about it, right? They're not just a solar company anymore. Now they're starting to be more energy management systems. Now, the company is continuing to expand laterally already, right? So they're already planting seeds for the future. They recently acquired a company called Clipper Creek, which, believe it or not, actually makes electric vehicle charging stations. Right? So the company is adding to its roster of products, and what that does is that anytime someone goes to install solar panels on their roof, well, the installer is going to be able to upsell them on getting a battery pack, getting some electric vehicle charging station, and so on. Eventually, they can use Clipper Creek, they can expand to the commercial businesses, and so on. So that's the beautiful thing about Enphase, that they're no longer locked into the residential solar category. Now they are more of an energy management systems company, and that provides them a lot of ways to expand both on the retail side and the commercial side in the future. Now, last thing I want to show you guys on the macro trends category, like segment of the video, is the price of energy is going up right now. Everyone is complaining and worried about inflation. You have oil, WTI, at $87, which is a high since 2014. And all the analysts are expecting it's going to go to 100 plus. Now, why is that relevant for Enphase? Well, there's a direct correlation between the price of energy and the adoption of solar. What that means is that the higher the energy costs, the more solar there's going to be, because people are more incentivized to switch, right? So that provides more demand for Enphase's products. So just keep that in mind, right? You're kind of like hedging yourself against the inflation, hedging yourself against the price of energy going up in 2022, 2023 by going with a company like Enphase, because they are going to be actually benefiting from the price of energy going up. So we like the macro trends. Now we have to look at the company itself, right? What price does it make sense to actually buy low and eventually sell high at a profit? And here, remember, this is just my opinion, my investments. I feel like $123 is a steal for this company. So if you look at the 52-week range, 108 to 282, so we're definitely not buying in at the peak right now. So market cap 16.71 billion and P ratio 107. Now we are in a phase of the market where growth stocks are getting punished, right? So if you look at the chart here, you can see the stock has really fallen off a cliff since November and dropped from $282 to $123. So there is an overcorrection right now, and that's what creates the opportunities. We can buy into this stock at the same price as May 2021, even though the company is generating more revenues, more profits, and has more products in the market. So you have to keep in mind, though, that because of the difficult market we're in, you have to invest like wisely. So for companies like these that I have very, very high conviction on, what I like to do is phase into the company. So that means you're not buying all of your shares at one time, where if the share price continues to drop, then you're doing what's called bag holding, and you're like, well, the stock needs to go back up 50% for me to just break even. When you phase in is, let's say that you want to buy 400 shares, well, you're going to be buying shares like 10 times blocks of 40 shares, right? So you're going to be averaging your cost basis over time. That means that even if the share price continues to drop, well, your cost basis constantly drops. And then when the market actually stabilizes and the stock starts to go back up, like you're not going to be down 50%. You're going to be down maybe like 10% or something. And it's going to be very easy for the stock to catch back up to your cost basis. I hope that makes sense, right? This is the part of the market now where you have to be phasing in rather than do like one big purchase. So if you account for the growth rate, even 107 P ratio is not that high for this stock, right? I know it sounds counterintuitive, but if you look at the PEG ratio, it's 1.14 rather. And if you compare that with, let's say, AMD, another company that I like a lot and is seeing more profitability now, it is at 98 cents or 0.98. So those companies are fairly similar, as you can see. And as the price drops, well, you get even better ratios. Now compare that with, let's say, Tesla, that everyone likes, but Tesla is very overvalued when you compare it. So Tesla's PEG ratio is 2.17. So as you can see, like either Tesla is way overvalued or Enphase is way undervalued. It's probably somewhere between the two. Speaking of valuation, you guys understand that when I make these videos, I have to cut some corners to keep the time short so I can keep your attention. So what I'm going to do is I'm going to show you someone that's bearish on the stock and what their price target is, just to kind of counterbalance my enthusiasm for it. All right, so this person published an article on Seeking Alpha December 31st, 2021, so about a month before I filmed this, and they were basically bearish on the stock, saying that it's fairly valued. There's no big upside because a lot of the vector of growth has been priced into it. So the thing is that when they made this article, the stock was at $186, and since then it dropped by 33.73%. So if you go down to like the person's valuation that he's using, his price target, here it is. So according to our valuation, the company's fair market value is 24.1 billion or 180.6 per share. Does that make you think that, yeah, maybe at 123, we're starting to get a little bit of a discount here? We're not really overpaying that much for the stock. And this is the type of company where on green days, it really skyrockets because everyone knows it is such a premium company with high growth and high profit, right? Everyone is scared of investing right now. But when the market is green and people pile onto it, this stock often goes up $10. All right, so I'm going to show you the numbers real quick, right, and then we'll wrap up. So for the third quarter, $178.5 million in Q3 2020. This jumped to $351 in Q3 2021. So the company's revenues doubled in 1 year. Now, if you look at net income, 41 million to 84 million, so that also doubled, and the diluted earnings per share, 30 cents to 60 cents. All right, so that is from 2020 to 2021, and the good thing about this company is that it literally grows every quarter. It's not just year over year. It is quarter after quarter, the numbers get better and better. Now, in the short term, they are struggling with the supply chain issues. That's the downside to a company that actually like has to produce products. The gross margin is a little bit lower than digital only companies, right? So like the containers went from $2,000 to $16,000 or something like that. So it's costing them a little bit more to actually ship the goods. So even though they are passing on some of the cost to the consumers, well, their profit margin has dropped a little bit. If you notice, it went from 41% to 40%, right? And it's kind of like hovering around 40% right now. It is expected that as the economy reopens and the supply chain issues get resolved, the profit margin is actually going to go up, which is going to be very good for the company. So if you look at the projections for the quarter that they're about to report now, as you can see, they're reporting like they're expecting 37 to 40%, which is going to be a little bit lower. But again, like in the next year, as they get more suppliers, since they get bigger, right, they get more economies of scale, the margin is going to improve. So the company is expecting 390 million to 410 million for this quarter that they're about to report. And usually what tends to happen with this company is that when they report good numbers, look at the spikes that you can get. So I don't know if it'll go back to 280, right? I really doubt it at this point with the current market. But I would not be surprised if in early February, when they report, we might see another big spike in price. All right, guys, as I wrap up the video, I want to show you one more thing that's going to be a little impactful, hopefully, is that the company is not sitting back on its laurels. They are going to continue to improve their products and add more to their portfolio. Look through your portfolio. You have probably some companies that are growing 30, 40%, right? That's the type of company we're investing in, growth stocks. Well, the problem is most of them cannot generate profits. They are always blaming stock-based compensation or their profit margins too small, R&D, advertisement costs are too high. Whatever the reason, they're growing, but they're not profitable, right? There's very few companies that can do both at the same time, and Enphase is one of them. But that doesn't stop them from actually innovating and continuing to distance the competition. They are seen as the most reliable with microinverters and batteries also, as far as I could tell, right? So if you look at this is one of their latest generation of microinverters, the IQ8, and it is another game changer. I won't bore you with the details, just read one line here. Unlike competing devices, IQ8 is capable of forming a microgrid during a power outage using only sunlight, providing backup power even without a battery. So a lot of solar consumers are frustrated about the fact that when the power is out with the utilities, they can't use their solar panels because the company doesn't want the linemen to actually get electrocuted, right? So the systems are off. So you have like solar panels that you want to use when the power is out and you can't. Well, now with their latest product, you actually can, right? So all these innovations from Enphase is going to allow them to continue gaining market share, continue to grow, and make solar actually attractive for people when it wasn't really that attractive 5 years ago. The costs were too high and there's too many restrictions. Well, now it's just getting better and better, and Enphase is at the forefront of that. All right, so let's look at the price real quick. So at 123, I would say that, you know, in my personal opinion, remember, always my opinion, anything under 140, 150 is a pretty good price for the company. Of course, if we reach $100 is when, like, I'm going to go into margin just to buy into it more. Right, currently I have 200 shares, so about 25,000. I have to keep some money in case the share price keeps dropping, but the more it drops, the more I'm going to be buying. I want to make it one of my top 3 or top 5 positions. I feel like it is by far the best stock of 2022. So do your research. Let me know what you guys think, and I'll see you guys in the next video.